So I think there's a clear mismatch of supply and demand here that is not appreciated in the price yet of most of these metals and the mining companies. And we're early here. So, you know, to me, it's the time to be looking for these opportunities more and more. And institutional capital will follow along, in my view.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has been predicting an oncoming boom in the commodity complex for a while now, and increasingly it's starting to look like that the boom is arriving. If so, how high will it go, and how long will it last? And where may the best opportunities lie for investors? For answers, we turn to macro and commodities expert Tavi Costa, formerly of Crescat Capital, but now newly running his own show at Azuria Capital. Tavi, thanks so much for joining us today.
Adam, thanks for having me. Looking forward to this conversation.
Me too. I've been looking forward to getting you back on for a while, Tavi, given how a lot of the things that you've been predicting now seem to actually be happening in real time. We're going to dive into all that just very quickly, and I'll give you a chance to say anything more about this near the end of the discussion. But congratulations on starting your own operation there at Azuria.
Yes, I'm really looking forward to starting something of my own and really working on some of the principles of investing that I have built and believe over the years. And this, if anything, this has been an incredible exercise of thinking about. I think when you, as you know well, Adam, I think when you start a new business is always about thinking about what you do best, and then sort of building from there your expertise and creating an edge on whatever it is for each one of us. And so that was for me. I've never seen myself as a trader or as a person who really understands the markets in the near term. I think I'm as good as anybody in the audience and when it comes to that. But what's been very helpful for me over the years has been just really thinking about long-term ideas and really trying to build a strategy that is as asymmetric and as the most value I can create in those strategies over time. I think there's a few of them. Mining to me is always been the over the last few years something I've been focused on. I think we're still early in that. So that's going to be our first vehicle. We're going to invest in the mining space, mostly focus initially in all parts of the industry, not just exploration, not just development and bringing companies into production, but also structuring deals that are similar to what we've done in the past with San Cristobal, which I think is true generational wealth opportunities that you create when you structure the right deals. And so that'll be a big part of it. And as we build Azuria over time, I think that will be important to have other thematic ideas. And one of them that comes to mind would be probably Latin America, given my background and also my beliefs of the structural shifts happening politically and economically in that region. And lastly, energy. I mean, energy to me is becoming increasingly a relevant part of my own portfolio, but also something that I view as a major or I should say a compelling thesis that is starting to unfold in my view, and would have a lot of opportunities too. So that's in short, that's sort of what I'm working on, and I'm extremely excited to be building this and hoping to be onboarding folks in the next few weeks.
Well, that's great. And I just got to say, you have all the ingredients for success here. I'm going to mention the details of St. Cristobal in just a second, but you're already so respected in the industry for the work you do in identifying trends. You're one of the best chartists known out there, and we're going to walk through some of your charts in this discussion. But to have kind of reached this stage by your mid-30s, very impressive, and you're right at the right time to be going out on your own here, Tavi, and I predict great things are going to happen for you. And just to give folks, and Tavi, feel free if you want me to edit this out when I edit it, but you are already, a very proficient deal maker in that St. Cristobal mine that you talked about. The deal you put together, I mean, you get a few of those grand slams in life, but that's an amazing performance.
Yeah, I don't know exactly what's the upside in terms of when you start looking at prices of what something is worth in this silver market, and on top of it, what you have in terms of the change in political environment we've seen in Bolivia, which was heavily discounted as a place where we would see nationalization and issues with the mine that we acquire. It's been the complete opposite of that. No, I went to meet the government a month ago, and I was just shocked by the capitalist agenda and the optimism that the team in general was looking to accomplish. And I think there's going to be a lot of good and positive things to come out of this. And I believe Bolivia might go from a discounted jurisdiction to maybe a premium jurisdiction as we see one of the most unexplored parts of the world potentially coming online and attracting capital from outside. Not only that, what I would also mention is, I wasn't the sole person who executed on this execution on this deal. Certainly, there's a group of very sharp individuals that were part of this, and that's the only way you can accomplish these types of ideas. And so, some people would see silver prices at sub, call it $15 an ounce or so, and claim that that's the time to be acquiring this. Every person will play it in a different way. I know very successful people that wrote a book about it, which was a great place to do it. Other folks decided to buy the metal itself physically. Others decided to do it on the future markets. Others decided to do in the mining space. And I did a lot of pretty much all the above, but one that I think the most rewarding one was certainly acquiring a mine outright with about 80% leverage at that time, which it was not only difficult to raise money in Bolivia, but also it was daunting with silver prices where they are. And so when you get those things right, and we triple a resource and we found a major discovery, and that's how you really create value. So excited to do this more often. I mean, it's not, those deals, people think that you can only do it once in life, and I don't believe in that. I think, especially now in energy and other places, I think that's where you can accomplish similar deals that we found in mining a few years back. You can probably find it today as well. So there's always going to be opportunities out there. We just got to keep our eyes open and try to structure the right thing at the right time.
All right. Well, I wish you all the best of success in going off and really fully focusing on that now that you're solo. And at the end of this discussion, we'll let interested parties know if they want to learn more about Azuria, where they can go. But let's roll up our sleeves and get to the meat right off the bat here, Tavi. I'm going to ask you kind of my general opening question with a little bit of a twist. But can you give me just your general sense of the current, how you see the current state of the current financial markets writ large, and then tell me where you think commodities fit in that? Because, one of the charts you're very well known for is a chart of the commodity complex versus the S&P. And for a long time now, it had been pretty much at I don't know if it was an all-time low, but certainly at an extreme low. Um, is capital starting to really rotate in meaningful ways to into commodities now, or are we still kind of in the first inning here?
No, I think it's still first innings for a lot of real assets. It's not just commodities, but mostly commodities. In there's going to be a lot of ways to potentially structure these ideas. But in my view, the mining space is going to be the most interesting one and potentially the most relevant one over time, just given the structural demand that we're seeing on the back of artificial intelligence, data centers, the revitalization we're seeing on the demand side of industrial parts and of the economy. And so all that onshoring is going to feed back into mining. It's fascinating to me when you start looking at the commodities space. You find a lot of legacy industries that have been forgotten. They're just under owned, historically speaking, and also their relevance when it comes to market cap in aggregate relative to global equity markets have diminished tremendously. I think that the issue that we're seeing here in the last few, call it 2 years or so, is that institutional capital was mostly caught off guard. And this was a wake up call for a lot of people. None of these institutions, the large pension funds and hedge funds, I mean, you name it, none of them own a substantial amount of mining. Very few parties actually had allocation towards this industry and other commodities, if that's the case as well. But mining specifically was just being neglected for decades. And then in the last 2 years, that sort of flipped with metal prices starting to rise. Initially, a lot of people were skeptical about that, starting to flow into the miners and the businesses that actually generate these hard assets, which to me was just insane that people would try to justify the lagging effect that was just a structural problem with the industry. I just thought was a normal lagging. And finally, institutions began to kind of sort of rush into the space in a big way. I really mean rushing. I mean, they started to acquire most of the seniors, royalty companies, the easy ones to understand. And investing, as we all know, it's an exercise of accepting risk over time. And as we saw those things play out, people started looking at the smaller parts of the industry. But you don't fix decades of neglection with 2 years of good performance. And so a lot of people have started to ask the question, are we seeing a peak of the mining cycle? And I could not disagree more. I think we're seeing is that wake up call. And I think institutions wanted to show their clients as well that they have an allocation in the mining space. I think the questions they're asking are wrong in a lot of ways, and which shows to me that they're just early and getting up to speed with the learning curve of this industry, which is so complex. No, the questions that we get about rare earth, the questions that we get about minerals that are just meaningless, right? They're critical to a lot of things, but it's not the market that you want to be focused on. Like you need one or two players, you're going to oversupply that market. And so, copper, silver, gold, nickel, zinc, these things matter. And, institutions either wake up and start allocating capital into those areas smartly, or we're going to be in trouble here very soon. I like to say this, but if you look at the discovery phase, that's usually a great way to find the peak of the cycle. How many discoveries of gold? Let's just use gold as an example for now. Have we seen in the last 2 years that are major discoveries, over 2 million ounces of discoveries? Zero.
I was
Two
going to
years
say, I'm going to guess very few. Zero. Okay.
Zero. Do you know how many times we've seen that in history? Never, right? So, well, how many times? How many have we seen in copper? Single digits. I think it's like two last year, and then maybe one the prior year. And if we looked at the prior decade, it's been single digit discoveries as well. And if we looked at the prior years in eras when we've seen the peak of the cycle, we're double digits on discoveries. And so we don't have anything coming online. We have enough copper in the world, but none of that copper is above ground. It needs to be mined. And so I think there's a clear mismatch of supply and demand here that is not appreciated in the price yet of most of these metals and the mining companies. And we're early here. So, to me, it's the time to be looking for these opportunities more and more. And institutional capital will follow along, in my view. If Azuria can be the bridge of that would be great, right? But I think there's going to be, we all know each other in the mining industry, right? I mean, most of the guys that have been doing this the right way all know each other. I hope all of them are able to also, bridge the gap of knowledge from institutions to this industry, because we need that. I think society needs that. So I hope that will be an opportunity for a lot of folks as well.
Okay, so two rapid fire questions for you. So it sounds like you're saying institutions, after a long time of kind of neglecting, ignoring this sector, are now starting to wake up to it. The institutional money obviously is where the really big money is. Um, how much have the institutions woken up to and started investing in the commodity sector? Is it still like just the very beginning, or are we mid innings on it? I think from your tone, you still think it's pretty early on, but I'm just trying to figure out how much more of the wall of institutional money do you foresee coming into the commodity space?
Yeah, that's a good question. I'm going to share a chart here, if you don't mind, which I
Go for
think
it.
it speaks for itself. I hope you can see the chart right now, but it's basically looking at the mining industry aggregated market cap relative to global equities. And you can see that the relevance of this industry in the past was, substantially higher than it is today. 1900s was about 10% or so, 70s and 60s was much, much higher than what it is today. We're down to about 1%. Global equities continue to go higher in values, which makes also the mining industry even less relevant over time. You can also look at the mining industry relative to gold itself, right? I mean, gold is now at a $35 trillion, or I should say $30 trillion market above ground. The mining industry remains really small relative to this. And so I would also argue that no other time in history, potentially, we've seen so much structural demand coming for mining at a time also when supply has been so tight. I mentioned a few things: artificial intelligence, onshoring, the electric vehicle revolution, the U.S. administration pushing for critical metals. I mean, the situation that we have with the debt problem. It's very clear to me that every decline we see in metal prices, it's being purchased by a very large player. Who knows who it is, right? I mean, I think we have some ideas who potentially is: central banks, other sovereign institutions, but things are changing. And I would say something even more important here, potentially, is we in the US and other places have been looking at the mining industry from a discounted cash flow, framework. And I don't think we'll be looking at that way in the future. I do think that more and more we're going to be looking at the way China is looking, the way maybe other places are looking as well, and the way that these places have been pricing some of these mining companies and others is from a securing metal valuation. And a securing metal world, none of us know how this is going to be valued. And, this is not going to be, in my view, that's the craziness of the world that we might get into in terms of the relevance of this industry over time. I do think that sovereign institutions have began to really realize, not just China, but even the US started to realize that subsidies and investments from the government are going to be absolutely critical to allow some of these projects to come online very soon.
Yeah.
And
Hey,
that's
Tavi, I'm sorry to interrupt. I just want to note on the day that we're recording here, just a couple hours ago, Vice
yeah.
President J.D. Vance just announced that the U.S. is going to establish this new system that's going to establish price floors for critical minerals, for the U.S. and its key allies, to make sure that they, continue to get access to the key minerals they need. So obviously, that's going to require a lot of sovereign buying to make that marketplace happen.
Yes, and I mean, think about this, right? Why are we seeing? I think we should get into another discussion that is important too, because the dislocation is a lot of people have rushed into the metal space, and so you've seen metal prices go up significantly. Have they reached a peak? I really don't believe so. I think there's, in nominal terms, it's never the best analysis you can make. You should have said that maybe the S&P was expensive 10 years ago, but in nominal terms, it keeps going up. And the same thing it's happening with metals. None of us know from a nominal term where things could go, but from a relative perspective of monetary dilution we've seen globally, I think we're just getting started in this. And so I do think that the big dislocation remains in the mining space. And this type of behavior that we're seeing from governments right now, to me, is an acknowledgement of, money managers in the mining industry have always thought about this more, I guess, practically, in a way of, why buy the metal itself when you can buy, for pennies on the dollar, if you find the right, operational team to execute on producing a certain commodity. And I think that most of these governments are realizing that too. Why should I buy gold, copper, and silver even in the market? I'm sure they're buying it too, but when I can also potentially acquire the metal supply
Right.
by
But buy it cheaply and lock up the future supply. Yeah.
correct. And so I think that's happening. And the only way to potentially explain the dislocation in mining stocks relative to metal prices today, which remain extremely cheap, is that the market thinks that metal prices will at some point come back down. And I couldn't disagree more with that. I don't think we're going to see, if we see a $20 silver price environment again, boy, I will certainly look for another St. Cristobal immediately. I think that that would be a wonderful, thing to investors. But am I planning on that? No, I don't think that we're going to see that. In fact, I think that mining companies today, what we need to keep in mind is that a lot of them let's speak on the silver side for a minute. They, a lot of these companies are still, their cost structure is still sub $15 an ounce, right? $15 an ounce. If metal prices, every day we see metal prices at about, I don't know, above $50, it's a good day that we should be celebrating because our margins are better than Google's margins, are better than Facebook's or Meta's margins, are better than Amazon's margins. We finally have technology like margins in the space that we've never probably had. And so it's a wonderful environment for those that are in that business. And I think this will continue to be the case here.
All right. So, gosh, so much to talk about here. Real quick, I just want to note to the chart that you just showed. I was at a conference a few weeks ago, and there was a gentleman named Brian Dunlap from BlackRock who was there, who was talking about the coming, infrastructure, just massive amount of infrastructure demand. And in addition to your list, he had, basically like also just rebuilding our infrastructure. Here in America, we have a bunch of dams and highways and our electrical grid that are old and are going to require trillions of reinvestment going forward. So this is a worldwide number, but he says, or BlackRock forecasts that the world is going to need to spend 106 trillion by 2040 in infrastructure. That's almost 4 trillion a month, if I got that right. That is just a mind-boggling amount of money. And kind of where I'm going with this is the spirit of what I'm hearing you say, and I just want to make sure I'm hearing it right, is there is this tidal wave of demand coming for commodities in the future for a whole bunch of reasons. And in your opinion, the market is dramatically underpricing minerals relative to that demand right now.
Yeah, and I think there's a lot of ways to think about this. I mean, the way this gentleman said is one way. I looked at some of these types of analysis in the past. I also think that, look, everything ties back to your views on metal prices eventually, and it ties back to gold itself because gold is the big gorilla here that we should all be watching to sort of see where things move forward. And just knowing, I think was Kathy Wood that put out a chart that showed the gold value, above ground relative to money supply in the U.S. and shown that basically we're seeing one of the highest levels in history, and she was calling for the peak of the cycle. If you don't mind, I would like to really address that because I think it's institutionally important to understand what's happening. I'm going to share my screen again because I think it ties back to your question. Okay. When we looked at, that calculation that she did, we're looking at a US, money supply situation versus a global market of gold value. Well, that's not right. It's the same thing as me looking at, US technology companies relative to US GDP. That is also probably a chart crime as well because most of these companies are global, so we should be looking at technology globally relative to the size of global GDP as well as part of this calculation. So let's assume the US situation for a second, which to me is a critical one and is probably going to be also what's going to move the world. How much, instead of looking at M2, which is smaller than how much we have in debt outstanding today, debt is approaching $40 trillion now. I think we're 38.5 trillion. How much do we have in gold reserves? Well, if we use the prices that we're seeing right now, let's call it about $5,000 an ounce, which is about the range we're in. It's about 3% of the government debt, 3%. So, okay, well, that's an interesting calculation. Let's go back in history and see what we saw in the past. Well, back in the 70s or 80s, at the end of the last gold cycle of the 70s, not the last one's in early 2000s, but we hit at about 18% of gold reserves in the US relative to total debt. Back in the 40s, when our debt problem was just as severe as it is today, at about 140% of GDP on the public side of public debt, we had about 51% of gold reserves relative to the debt problem that we had in the past. That would assume some insane numbers. If you do the calculation of if we ever go back to a debt problem that is actually backed by about 51% of US gold reserves, I don't think I want to be mentioning those numbers. It's in the chart. You can see it yourself. But, you know, all
I'm
I'm
going to
saying
mention it
is,
just for the folks who are listening on the podcast who don't have
yep,
the visual here. So yes, today roughly 5,000 an ounce. Back around the 1980 period, as Tavi was talking about, implied price of gold of $26,000 an ounce. If we look at the metrics there back in the 40s, it would imply a gold price of $75,000 an ounce.
now, I know a lot of people may be, calling myself a lot of names here. I'm just using math. I'm not doing anything. I would call Kathy Wood and say, well, maybe, I would love to discuss this. I mean, I don't think that her calculation is correct. I mean, if she does it just looking at the US market today, where we are, this looks awful. And why not look at money supply globally? Now, China alone increased money supply by $15 trillion in the last 3 years, okay, or 4 years. That's insane, right? I mean, the US, it's basically more than half of the US money supply, throughout history, has accumulated over history. So,
Jeez.
we really need to think about this from a global standpoint because the actual buyer of the metal is not just the US potentially. It could be, we know that other countries like China are accumulating the metal in amounts that none of us really know what it is. Prices wouldn't be moving the way they are if it wasn't for this. I think Luke Groman put out a great comment the other day where Scott Basson made a comment about how much gold prices have been helping the U.S. economy. Well, he's talking about this chart, right? I mean, he's talking about how much the increase of gold reserves is helping to back the overall debt. But
Hmm.
we're far from an area that we've seen in the past that gave us some level of stability in the country for the fact of how much gold reserves we have relative to the imbalances we have. And so I don't know. I just think we're so far from those issues in terms of calling it a peak of the cycle. Look at charts like this. It's just to me, it's really what matters when it comes to the long-term view of this metal specifically.
All right. So Tavi, let me start asking you some rapid fire questions. I mean, I could talk with you for hours and hours, but we don't have unlimited time here, unfortunately. So you made a great case for why you think the commodity complex is likely to do quite well going forward. Um, I want to ask you about your thoughts on some specific sectors, if you don't mind, and
Yep.
not that you have to, but if as we talk about each sector, if there's a company or two that's got your particular attention that might be interesting for viewers who are, warming up to this space to go research, please feel free to announce them. I'm sure people would love to go, explore,
Yep.
explore those companies' prospects on their own. So first off, gold and silver. They just had a really, historic day last Friday where, the metals got caught in a downward price vortex. Many people, myself included, were warning that this might be coming, just given how vertical the price action had been, especially in silver.
Yep.
Now the big question is okay, is this just a correction in a bull uptrend? And it'll take some time to recover, but then we'll see higher prices down the road. Or, is this going to be more like 2011 or 1980, where the metals basically gave up all their games and then went to sleep for a decade or more? I'm going to bet from everything you've told me so far, you don't think it's the latter there, but I want to get you on record just clarifying however it is you're looking at this.
Yeah, no, I think that's the most important question. The latter part of your question is the most important one, is it's impossible to know the path moving forward. And anybody who tries to do that is, it's not. it's really impossible because we don't know who is really accumulating this in a large way. And what I can tell you is um, in a normal price environment of any asset that we've seen this level of volatility, you should expect some digestion, right? I mean, a lot of people were caught off guard from a portfolio management standpoint. And if anybody is building a portfolio with silver, it will change the way they think about risk after seeing a decline of over 30% on the price on one day. And so that should create some volatility, of course. We're not going to just go back probably to prices that we were just a week ago. But and if we are, I don't mind being wrong there, right? Because I'm not selling mine either. So what I think the important question for an investor that is taking that 5 to 10 year horizon sort of planning when it comes to investing is the second part of your question. Are we in a 2011 period? And I really don't think so. I mean, I'm going to mention a few check boxes that I would change my opinion on. That would be seeing capex relative to metal prices at all-time highs, is seeing M&A activity to all-time highs, is seeing gold as a percentage of balance sheets of central banks at all-time highs. It would seeing metals relative to money supply globally at all-time highs.
A surge in discoveries.
A surge in discoveries. What a great point. A surge in discoveries, a surge in production, right? You can see discoveries, but then you need to build those discoveries to become producing assets that then change the supply curve. And we haven't seen that yet. Institutions, how much do they own of metals? How much do they own of miners? Pretty much nothing. And so when that changes, I'll change my view. So there's a lot of things in that checklist that back in 2011 were the case. And if they become the case, which I think we'll have time to assess those changes, we can then say, well, this is the end of the cycle. Now we should probably move on to another idea. And I would be happy to be one of those guys speaking out my views when that's the case. I mean, I've spoken about other situations, about other themes in the past, and I won't not shy away from being very realistic on what I believe in this mining industry cycle that we're seeing.
Okay, great answer. And I apologize. I'm just going to keep hammering you with this machine
You're
gun
good.
list of questions. Are there any one or two publicly traded mining companies right now that you think look well positioned to you that interested readers or viewers might want to go check out? Not personal
Uh,
financial advice, but just things that are on your radar.
in the gold space, there's definitely a few. I prefer not going there if you don't mind. I think I've never. There's a company that I really like still that a lot of people have been considering on the side as potentially finding other discoveries in the area. I still love Snowline Gold. I still own it. And a lot of people are looking for the next Snowline, and I think that they are the best positioned company to continue to find new discoveries in their own ground. They have one of the best established properties in the region, the best team, the best cap structure. And when you find good operators, when you find good management teams with high quality assets that anchor the value of that stock, you just own it. And that's what I've done. I bought shares pre-IPO
Oh,
and
good. Look at
I
you,
still
my
own
friend.
it. I still own it. I have not sold it and I still own them. And I'm with this team for the long haul because I really believe in it. And so, yes.
All right. Two things about Snowline. One, I had Carson Block, the sort of famous short seller, on a few weeks ago, and one of the companies he's actually very bullish on is Snowline Gold. He sees it as a good M&A candidate, but
He,
it's nice when smart people come to the same conclusion. I also have to note, just because you mentioned the company, I own it. I put a little bit of money in a few years back, and with the return that it's had, and I can only imagine what your return is on pre-IPO shares, but just a little bit of money basically paid for both my daughter's college educations with that single company.
I mean, Scott Burdell is probably will be one of the best CEOs in the industry. I think there's other CEOs in the industry that I'm paying attention to as guys that are incredible operators. I'll mention another one if you don't mind. I don't
Sure.
own the stock, but I think when you find these good management folks, you want to own them over the years. Aura Minerals, Rodrigo Barbosa from Brazil as well. He's an incredible story of success, and I think he's far from done. He comes from a different background than most of the miners in the industry. He's an engineer, but that was in a different industry in Brazil, and uh, he is some of the, probably one of the best mover and shakers of this industry as well. There's a few other folks, but look, I just wanted to say that Carson Block scared the crap out of me when I saw that Muddy Waters had a report on Snowline. I was like, oh no.
Because
And
you
and
you
then
thought it was going to be negative?
I respect their research so much. I've been following Carson Block for so long, and when I saw that he had a report on Snowline, I was just like, oh no, this is not good. And then I learned that he's long the stock, and I was like, wow, that must be a good thing. So, anyways, it's
All
interesting.
right. Okay. And again, folks, these are just companies that Tavi thinks highly of. No guarantees of what the stock price is going to do from here.
Yep.
That Aura Minerals, is that Aura, like Aura?
Yes, yes. Again, I
Okay.
don't own it. I've got a great relationship with the team, and I just see a bunch. No, I think of St. Cristobal as some of the most nimble, flexible, smart team that I know out there. And I think Aura is in the same position. These guys are really sharp.
Okay. Well, that's high praise. Okay. So moving on from the precious metals now, what other commodity sectors have your attention right now? I think I heard you mention energy earlier, but
Yeah.
where do you think the next wave of kind of capital rolling into is going to come?
Maybe I said this to you before, but it's fascinating how the commodity cycle usually rotates on itself. And, you have the flavor of the year, flavor of the month, flavor of the week, and people are talking about something, and then it rotates again. And so energy has been sort of in a consolidating pattern for the last 2 to 3 years, maybe even more, depending on the stock. And I don't think it's going away. If anything, I believe that energy, oil and gas, particularly oil, I know a lot of people understand the gas part from the aspect of electricity consumption and what we're going to see with AI and so forth, but oil should not be taken out of the picture either. And I find it one of the best opportunities out there today to be striking deals like we've struck over the years in the mining space. I think you're going to be able to find similar ideas here. In terms of things that I've been paying attention to, I like the mix of ideas, and I mentioned this to you before. Some of the companies in South America that have very large energy production that are also linked to a potential shift of leadership politically in the region is, to me, when you mix the two, energy and Latin America exposure, it's to me is one of the most compelling ideas out there. Petrobras comes to mind. I own Petrobras to options actually, and a little bit of the stock too. I not a little bit. I own a good chunk of Petrobras as well, but on the stock underlying stock. But I think there's other ideas out there. These things can become quite explosive as you see the cycle playing out. And so, look, I am very patient. I don't think you ever know how to deploy money here smartly so quickly, but I've been accumulating over the last year or two. And I think we're going to see a lot of changes there's inherently a floor of security in South America that is underappreciated in my view, politically speaking. And so I think most of the crazy politicians that we've had over the years in that region have literally a gun in their head to behave. And so as we see this, I think asset prices will start behaving better over the years as well. So it's an
Okay.
interesting part of the
When you
world.
say a gun to the head to behave, are you referencing in large part the recent U.S. operations in Venezuela to
Correct.
remove Maduro?
Yeah, I think that has changed the landscape in a large way. I noticed when El Salvador had a shift, and then you had Argentina change with Milei. Now we're seeing Paraguay, Bolivia, Uruguay, Costa Rica, Panama, and people are looking at Brazil and Colombia and saying, "Well, I don't think these places are ever going to change." Well, elections have not happened yet. That's why they haven't changed. And so,
And let me
there
just
is
note
some.
for viewers too, You're
Yeah.
Brazilian and you spend
Yeah.
a lot of time in Brazil. So you're not just talking academically here. You've got a pretty good boots on the ground sense.
I've never seen Brazil be so polarized, and so for folks that worry about Lula and others, rightly so, by the way, I think that he does not have the same capability of making drastic changes in the country as he had in the past, and so this goes to the right too. So I think both parties are going to be kept on check, and when you have this sort of gridlock politically in those areas, and potentially more of a capitalist agenda is starting to brew. When I went to Bolivia, for instance, I know you talk to people, is not coming from the US influencing changes in places like Bolivia. This is coming from the people. They want the capitalist agenda. Brazil is happening the same way. So I am I'm very optimistic about this region. I don't think this is a cycle change. This is actually more of a structural shift in the region. And so I'm really bullish in that area. I bought real estate in Brazil in the past for that reason. Did I know Brazil as a currency, Brazilian currency, the real would be the best performing currency in the year? Of course not. Did I benefit from it? Yes, but I did not know that that was going to happen. I just think if we see stability on the currency and we have commodities starting to play out, metals, energy, and others, these countries can see major changes, major tailwinds in terms of growth. And majority of these stocks in those areas have very compressed multiples. When you have compressed multiples with growth, oh, it's like nirvana. I mean, it's some of the best ideas you can come up with. So I sort of think that that's going to be the case in South America. Sorry for going long, but yeah.
No, 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 no. That's actually really useful and it's relevant to previous discussions I've had on here. I very much appreciate someone with your perspective actually spending a lot of your time in Brazil and having been from there originally. Um, all right, I'm resisting asking you more questions on that, but I want to bring it back to the true matter at hand here. Okay, so energy quite bullish on. We were talking earlier about, basically just the amount of capital that's going to go into, or the amount of projects that are going to demand minerals going forward. How about just on the base metal side? I mean, it seems like the world is beginning to realize it needs a lot more copper than, as you said earlier, is above ground right now.
All the themes you're talking about, I think, will fall into something. If I can share one research
Absolutely.
piece that I think is important. I think about the world from forget about the government. We talked about the government a bit, but let's talk about more of the private world. And you have these Mag 7, Mag 10 companies, right? Mag 10 companies today are probably generating about $500 billion a year of free cash flow, not cash flow, free cash flow. And then you look at their balance sheets today, they actually hold more, they actually hold cash in their balance sheet, meaning they net cash. In other words, they have more cash than debt in their balance sheets, and their balance sheets are clean. There's nothing there. I mean, there's a few companies that have debt and have an increasing debt, but from an aggregate standpoint, if we just look at them as one company called the Mag 10 or the Mag 7, whatever you want to look at, their balance sheets are clean and they're making a ton of cash. So it begs the question. We know that these guys are under, again, also with a gun in their head with the AI revolution. They all know that they have to spend money in order to become scalable. Otherwise, they're going to be out of business potentially. That's the way they are thinking. And so, if that's the way they're thinking, that's the way we should think about the world as well. If they're generating about $500 billion, what could change here in the future? I think that we could see that free cash flow is going to be diminished by the spending from capex in a very significant way. So for those that are thinking that these guys are going to hit a wall of spending, I don't think that's going to be the case here. I think these guys have long ways to go on spending. If that's the case, we need to think about the rotation of capital, rotation from that free cash flow annually that will be shrinked and will go into other pillars. Those three pillars that I've been thinking about. It's to me, it's energy, to me, it's materials, and to me, it's infrastructure. Those three are going to be the key pillars that are going to be receiving that capital. Now, there's going to be another aspect of this that is important to think about too, which is potentially the leveraging of their balance sheet. We could see, it shouldn't shock anybody if the Mag 10 as a company, think aggregate,
Hmm.
in the future are holding about 40% of that to assets. I mean, that could be normal. How much of unleashing of capital would be happening and coming into those pillars again? So I think, again, think about that and how that rotation of capital, which is happening already, but will happen in an even larger scale in the future as these companies leverage their position to build infrastructure, and a lot of beneficiaries here. Now you can ask the question as well about, well, would that mean that these companies are going to deteriorate their financials and their multiples are going to be unjustifiable at these levels? Probably. And you can play those two games here. You can say, oh, I'm going to play the short side of it. I'm going to play the long side of it. I happen to believe that the big opportunity will be on the long side, but I'm not saying that the short side won't be compelling as well. It's just not, I just believe that on the long side looks more compelling. But that brings back to base metals question. And if that's the case, I mean, just looking at copper alone, zinc, specifically zinc, nickel, these assets these assets are in a position to, I think, to do extremely well in the future, given the supply aspect that we know is very restrictive over the next years, and the problems that we have in current mines that are either being shut down or having issues operationally. I do think that those metals have long ways to go. I am looking for more and more exposure in those parts of the market.
All right. I want to get back to your three big pillars in just a second, but real quick, on those three metals, copper, zinc, nickel, or any other ones, um, any particular companies that come to mind right now where you're like, those guys seem to be well positioned?
Um, Public companies is I don't know if I
I
want to
know you
mention
live in the
public
private
companies.
world so much more, yeah.
Well, yes, because I think there's lots of opportunities on the zinc side in some parts of the world that we've been looking at. Zinc is in a position where you can basically control the market potentially. I'll mention one, Canadian Copper. It's a smaller cap company, so be aware of liquidity and other things. But
Canadian
uh,
copper?
Canadian Copper is an interesting company that has copper, zinc, and other interesting opportunities. These guys have received a substantial amount of capital recently on a capital raise to acquire a processing plant nearby their mineral deposit. They're, going to have a very clean path to getting to production soon, soonish. There's nothing soon in the world
Yep.
of getting into production, but they're also surrounded by a lot of mineral deposits that can be very strategic by owning this processing facility now in the region. And so, that's a very intriguing play that I think will do very well in the near future.
I appreciate that. And I hate to ask this again, I didn't quite catch it. What is the first name of that company?
Oh, Canadian Copper is a
Canadian.
Canada.
Okay,
Yeah.
great. All right, I did get that. Okay. So I very much appreciate you kind of walking us through the framework of how you look at the world. I'm trying to see if I can boil it down to something even simpler, which is currently there has been a tremendous amount of free cash flow generated by the hyperscalers, right?
Yep.
And they have benefited from that, right? I mean, their share prices have gone ballistic the past bunch of years. You're basically saying to be winners in the future in AI, they're going to have to basically take a lot of that free cash flow and they're going to have to give it to commodity producers, or they're going to have to use it to buy materials to do all their build out. So in essentially, it's a transfer of that free cash flow from the tech sector to the materials sector. Am
Yeah.
I being too simplistic, or is that kind of an easy way to think
No.
about it?
And I would say more, right? I mean, there's, that's exactly right. And I would keep it to the short sellers of the world to think about this. I'm no longer a short seller, but I think that the short sellers of the world need to think about the potential growth of their revenues as well, these Mag 7 companies, and how that could extend this spending cycle. But I just the reason why I mentioned this is because I do think there's a lot of people talking about how these companies are going to hit a wall of spending. And I I know it sounds great. It sounds like a doom and gloom, sort of headline way of mentioning, but I don't think so. I think these guys have, an open highway of spending here if they wanted to do that. And do I think there's going to be some cyclicality issues where in some years they're going to have to reduce spending for whatever is happening economically? Sure. I mean, but do they have a lot of leeway to spend money significantly and leverage their positions over time? Yes. And if you're thinking from the world of the arms race that we're seeing, not just among these companies, but also countrywide between US and China and other places, it will only reinforce these companies to continue to spend money. So um, it, now you talked about the three pillars that I mentioned, okay, and then you have this other pillar, that is the AI companies that are sending money to these other parts of the economy. Now, the bridge between them is financials, right? And that's the bridge. The financial companies will bridge that debt that will be
Hmm.
created over time. So think about them as an opportunity too. I mean, for those that understand that market very well, it'd probably be an opportunity. The way I view things is infrastructure is maybe not my field. I'm not going to pretend to be an infrastructure guy. Materials is definitely my field. I mean, I've been in the mining space for some time now. I'm going to play that side of it. Energy looks very compelling to me as well, and this is why I'm going to play that. But and as we see these rotation into of rebalancing of capital into those areas, eventually you start looking at other parts like emerging markets again, because emerging markets have a lot of these companies. They're basically built on energy, materials, and infrastructure. That's how these guys are built. And so potentially we're going to see a lot of that money going into those areas as well. And South America will play a huge role into being one area that will probably supply a lot of those materials over time for the US and other major economies.
So, I interview Michael Howell, who is a big liquidity analyst, and there have been times over the past years where I've asked Michael, do we really even need to look at anything else, or do we just need to watch liquidity flows, global liquidity flows, to understand where the stock market's going to go? Because it seems like such a dominant factor, right? And it's just very simplistically, you pour more water into a system, things are going to rise, right? So I almost feel, as simplistically, you can just look at what you're talking about here and say, well, look, as these hyperscalers pour, trillions more into the materials, energy, and infrastructure space, everything there is just going to mathematically have to rise. So it sounds simplistic, but I kind of like to invest by simplistic themes. I'm not that sophisticated a guy.
Hmm. Simple is good. Building a fund right now, it's funny how you get into those discussions of all these derivatives and different ways that you want to structure things. And I love the Warren Buffett style of investing. It's finding good companies, simple themes, and good management team. And in a lot of ways, those are all subjective opinions that you create. I think the value investing and bringing up, finding these good companies over time is going to be the way to really create value in these industries. I like the way he thinks about liquidity. Liquidity, on the other hand, inherently also has a more impact, a larger impact in the near term of things. I think that as an investor, I look at those things more as an opportunistic way. It's not like I'm changing my portfolio according to that liquidity impact, but rather holding more cash or less cash because of that, in terms of not rebalancing because of the liquidity factor, but rather holding more cash to then deploy money when I see volatility. I think most funds and institutional capital has moved away from volatility, maybe because of the interest rate regime and what we've seen in the past. And the next 10 years, I think good money managers are going to have to be able to embrace volatility in a big way. And it's going to be volatile, guys. I mean, there's not going to be a way around this. The way, the world is so levered, uh, you know, tied up your seatbelts here because it's going to be volatile. But those that have a clear mindset of what it will likely be the world look like in the next, call it 5 to 10 years, will be able to take advantage of those opportunities over time.
All right, my friend. Look, I could go on, like I said, for more hours with you, but we are approaching the end of the hour here. So, in starting to wrap up here, uh, if you can, just summarize for us how you are thinking about playing these opportunities here. And maybe that's all encapsulated by your new fund. I don't know. And then use that as a bridge to just tell people who are interested in following you and your work and maybe interested in learning more about Azuria, where they should go.
Yeah, look, I think there's going to be lots of ways, some ways that I'm not going to be involved either. But I I see the world from the lenses of a lot of US based assets allocation that will start shifting to other parts of the world. And as we see that, we're also going to see a commodity super cycle that will continue to play out from a rotational standpoint. And there's going to be lots of opportunities in that part of the market significantly. So the way I view the biggest trends that I feel comfortable deploying capital, and look, there's going to be things that I'm going to invest personally, but I don't feel like I have an edge on. And if I don't have an edge, I don't see the point of taking client money to invest. I'll just invest my own money. But mining to me is going to be a critical piece of where I'm going to be allocating capital in the future here. I think that's a very early stage long-term cycle that we're in. Institutional capital will start coming more and more to that space and understanding that industry. And as we see that, I believe that it's gonna create a lot of value for investors in that part of the world. Energy looks very compelling from an asymmetry standpoint. Now, more near term, I think that you can strike incredible deals. I've been trying to strike incredible deals. Let's see if I can accomplish that without sharing much more. But and if I do that, I think this is the time to be doing these types of investments in that space, finding the St. Cristobal of energy. Now, what a time to be doing that. And thirdly, Latin America is a place that I also find it interesting just because from an emerging market standpoint, about 80% of emerging markets index is in Asia today. So even not just a rebalancing from US to emerging markets, but also within the emerging market space, we may see a rebalancing into Latin America. I think Latin America arguably has the safest region today, politically speaking, and also the proximity with the US and the partnerships we're seeing with the US. Relative to other parts of the world is increasing. And if we think of those lenses, a lot of assets are very mispriced. And you can take an approach more traditional, not just so niche in mining. Banks, consumer companies, utilities. There's so many businesses in those areas that can do very well without the need of going so deep into value investing as far as in the mining industry of being so active. So that's going to be a different strategy, maybe more liquid strategy that could play out. Now, that doesn't take away the opportunity potentially in Asian markets either. I think there's going to be great, for those that understand that market, not me, will do very well. Will do very well in that space potentially. And so, yeah, I think the rest of the world looks very compelling. I think commodities look very compelling, hard assets in general. And I look forward to volatility. If I see volatility on the downside of any of these markets, yeah, I have cash available, I will probably be deploying capital in those things. And so I don't know if I said this to you before, Adam, but one thing I really value about doing your own homework is so important. And people say that in a cheesy way, but it's so important because when you get caught up, every theme that we all talk about here will be challenged at some point. And those challenging moments are moments where you deploy capital into those areas. And if you don't have conviction because you build your own conviction through your own research, you're going to be asking me or other guys that talked about a certain theme and saying, "Well, you told me this was going to work and it's not working out." Yeah,
Mhm.
I have conviction. I'm going to deploy more capital because I've studied this and I really believe in the next 5 to 10 years this is going to play out. So those that take advantage of those types of volatility in markets are really the ones that build a lot of value and wealth over time. So that to me is so important about doing your own research and not believing in other people's themes. Although ideas from network like yourself are so important, they trigger ideas. Go do your homework now, and go deeper. So, anyways, that's my motto at least, and I hope I can build that at Azuria. So, yeah, that's it. Thank you very much for having me, Adam.
No, thank you. Well, just please, the second half of the question was for folks who want to follow you in your work between now and your next appearance on this channel and maybe learn more about Azuria. Where can they go?
Website's been created, so my apologies, taking longer than I thought, but we'll have you can contact me on Twitter at Tavi Costa is my handle. There's an email there, Tavi at azuriacapital.com. you can email me as well there. But no, look forward to doing something here and building something that I believe strongly could play out very well in the future. So thank you very much for having me. I remember when you went on your own not too long ago, and
Thank
I
you.
knew you're going to do well. I had very high conviction that you would be one of the good ones, and so I'm happy for you, and I look forward to doing more of these conversations. I appreciate that you also contact me when I said it, and I appreciate that a lot. Most of the people that contact me, I won't forget that. I really appreciate that. Thank you.
Well, right back at you, brother. And hey, look, as I said earlier, I wish you all the best with this new venture, but I don't think you're going to need much luck, Tavi. I think you've got all the right skills and ingredients and a great market environment to do great things there. Thanks for coming on. Again, just a wonderful discussion. You're one of those guys who just always leaves it on the playing field and very transparent about what you do. I have a sense, Tavi, that there's going to be some demand from the audience after watching this to say, hey, can we do like a deep dive with Tavi on the energy sector or copper and zinc or whatever? And if you're open to that, would love to maybe talk to you in the future about having you come back on to do one of those deep dives.
You have my contact. I'm happy to do that for your audience anytime. So thank you very much. I appreciate the exposure as well that you created for me as well. So thank you.
All right, my friend. Well, look, the door is open for you to come in here anytime. But anyway, such a pleasure. You're a good man, Tavi. Appreciate the friendship, and again, just so thrilled at what the future holds for you and your new business.
Thank you.
All right. Well, now's the time of the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined this week by John Lodra. His partner, Mike Preston, is off this week. John, I know you've known and followed Tavi's work for a good long while. I'll tell you that guy just gets more impressive as the years go on.
Yeah, Adam, great to be with you and great to listen in and hear from Tavi. He always brings, as we said offline, brings a perspective, brings data, and we have indeed really appreciated and followed his work for a long time because he, like us, has been talking about the broad kind of backdrop that has given a really fundamentally constructive tailwind to real assets, whether you're talking about base metals, precious metals, energy. These are all big picture themes that we have long felt would be really important, especially in the age of monetaryism that we have entered in the wake of the great financial crisis. You print more money, the value of those printed dollars erodes, and the value of real things starts to take over. One of the things that Tavi ended with there was really struck me because I think it really speaks to a data-driven approach. He talks about, all things will change, right? All themes will change course at some point, and you don't need to get wedded to a theme, but the data will drive you. And he, have great respect for him. We had obviously long been promoting and suggesting precious metals, for example, especially the mining stocks, as a place that would likely do well. That was a hard place to be for much of the last, the 2010s. And surely all that has been made up in a very quick period of time in the last couple of years. But the data will change, and there'll be a time to sing a different tune. And I have no doubt Tavi will bring his usual wealth of charts and data to help him guide his viewpoints, just like we will. He talked about, again, precious metals, energy, basic materials, base metals. And he oftentimes will talk about Latin America, his homeland, and we as well have seen those trends emerge. So we see a lot of the same things together, and you always want to be careful that you're not in your own echo chamber. And I think both the data-driven approach that Tavi has and that we use here at New Harbor will hopefully help us and our clients avoid that risk.
Yeah, and you are investing on those themes, right? I mean, obviously you've talked a lot about your investment in the miners, but I also believe you guys, maintain a position in international stocks, and I think Latin America has been one of the areas you've been investing in.
Yep, absolutely. And we, frankly, we are more recent investors to, for example, the base metals, Latin America, and energy. Not because we didn't see a fundamental backdrop that was supportive, but we also use technical tools, things like relative strength, and we have a systematic process that marries big picture fundamentals with evolving data in the real time to not just what should happen, but what is happening. And I think it was last quarter of 2025, we entered both global base metals mining stocks as well as energy. And Latin America, I think, was maybe a little earlier in the year. So those three areas that have done very, very well, we held off, even though the fundamental backdrop was looking quite constructive. We wanted to see our technical signals follow through and give that ring of endorsement, if you will. So yeah, but very much have exposure in those to our clients. And just today we saw kind of the international equities kind of click up right above domestic equities in our kind of broad relative strength matrix. And that is no surprise. We have nearly half of our equity exposure in non-US equities, including Latin America.
Okay, well, just to make sure I heard that correctly. So of your equity exposure, half of that is in internationals
A
now.
little less than half. I think we have about 47.5% targeted equity exposure. That's not including gold mining equities, which we kind of view as a separate class. We have another 10% there. But about 27, 28% is in US equities, tilting towards some of the sectors we talked about, energy and things like that. But a full 20 of the 48% in equities is international equities.
Okay. Let me ask your opinion on something that David Hay said in my recent interview with him, and I'm not sure if you had a chance to watch it yet or not, John. But we were talking about Mike Green's giant mindless robot,
Mhm.
right? The passive capital flows, and how that seems to be sort of a dominant force in the markets up until the point at which, if and when there's a point at which something causes those flows to either flatten out or even worse, go in reverse, right? And talking to Mike, we generally look at like domestic potential triggers for that, like the unemployment rate spikes, right? So there's less money going into those retirement plans that are purchasing every month. David said, I actually think there's a bigger potential threat out there, capital flow wise, and that's foreign capital, which has rushed into the US markets over the past bunch of years, start to actually turn around and go the other direction. And he noted that you're starting to see outperformance of international stocks versus U.S. stocks. That actually was the case in 2025, and I think is still the case so far in 2026.
Very much so.
Some of these other economies are really starting to benefit now from greater demand for the commodities which they produce. But importantly, there's also sort of a sentiment out there, which I told David my opinion on, which is I don't think the sentiment matters until the economics do. Meaning, there's a lot of countries out there now who are not thrilled with how the U.S. has been kind of flexing its power, and they're thinking like, well, we'd like to take some of our capital out of there. I don't think they're necessarily really going to do that at scale, unless and until that capital is better treated in a market outside the US. And so now that we're starting to see that, that's providing a reason to start rotating capital out. And you're getting kind of a kicker on top of that in certain countries like South Korea, which is kind of having a repatriation campaign. And they're saying, look, if you bring your foreign capital back home, we're not going to tax you on your gains. Right. So all of a sudden, there's starting to be, a pretty compelling economic carrot, at least in certain countries, to start thinking about taking your money out. And I'm just curious if this is something that you guys at New Harbor think of, and if it were to actually pick up momentum, what kind of impacts do you think that would have?
Yeah, so it's absolutely something that we think of. We think is very much at play. I think just yesterday, Ray Dalio was out talking about the prospect of what he calls capital wars, right? The whole idea, like, look at in the wake of the great financial crisis, there was probably an unprecedented level of coordination among the world's central banks and governments on how to kind of bail out the global economy. The global economy got, in synchrony, got wrecked, right? And you know, every major central bank followed our Federal Reserve's lead in terms of printing and government spent and all kinds of fiscal and monetary stimulus. And now we have today where there's the pendulum is swinging quite visibly, even by the layperson, the other way. There's a sentiment of every country for themselves. We don't trust each other anymore. We're trying to bring resources back home. There's literally every country is talking about needing to get stockpiles of critical natural resources. Yeah, this is a world that is becoming a lot smaller real quick. And certainly in that backdrop, a protection of one's own capital, especially after a run in the US, for example, like we've had. I mean, people are rightfully, I think, worried about the sovereign wealth funds. Is this AI thing? Has it gone too far? Is American exceptionalism, more than priced into the markets? And so absolutely, I think it's a risk that is very much at play. But more importantly, we're seeing it in the price action. We have most of last year, we saw non-U.S. stocks, much stronger on a relative basis than U.S. stocks. And again, I mentioned earlier in the interview here today, just today, we saw a long-term relative strength indicator flip international stocks ahead of U.S. stocks. This doesn't happen. Last time this happened was briefly in 2022 when the markets were real challenged. But the last real episode of this was back in the 2000s, right in the wake of the tech bubble. U.S. stocks got wrecked. Non-U.S. stocks did relatively better. So these are trends that happen not every year. I think we're probably in store for a multi-year period of outperformance. Valuations, while still higher than they were a year or two ago, international markets valuations are comparatively much better than U.S. stock
Hmm.
valuations, broadly speaking.
So let me ask you this. So a lot of the ink so far this week has been raising concerns about the performance of the hyperscaler stocks.
Mhm.
And if you look at a chart of the S&P, which is, heavily influenced by the prices of those hyperscaler stocks, it's very clearly now kind of just gone sideways
Mhm.
for what, since October or so? So October, November, December, January, February. That's 5 months of basically sideways action here. Um, I'm just curious, at what point would you guys at New Harbor, what would you be looking for to say, okay, we no longer think this is a consolidation phase to be followed by higher prices, but we think this is a top that's being put in and that
Mhm.
lower prices will lie ahead.
Yeah, so we have a wide variety of breadth indicators. We look at things like across broad markets as well as indices, the percentage of constituents in that indice that are trading above certain different moving averages. We look at bullish percent indicators, which it's a technical term. Bullish percent indicators basically tell the percentage of stocks within a given universe that are on a buy signal, a price buy signal. We look at a variety of different things. And what you typically will see in a topping market is those breadth indicators start to, even before the indices themselves start to turn down in any meaningful way, those breadth indicators start to collapse very, very noticeably. And we actually have seen some tiring in those breadth indicators of late. And certainly a couple of days action like we had yesterday and on last Friday, helped to precipitate that. But that's what we would start to see. We would start to see visibly underneath the surface, if you look at the data, fewer and fewer stocks, playing along with an index that's hanging in there. And we absolutely are seeing rotation among sectors. I mean, look at software stocks. The headline news today is all about SaaS software getting decimated. The software subsector of the tech space has absolutely gotten killed lately. Folks are worried about, and probably rightly so to some degree, that the agentic AI and the kind of the coding cloud. I think that cloud is the coding agent of, I forget if it's Anthropic or whatever. But there's a lot of worry that these moats of these SaaS software companies are quickly going to be eroded. That these margins that were priced in to continue forever are going to be anything but that. So we're seeing it underneath the surface, sector rotations, but also broadly speaking, we're starting to see some kind of tiring in some of the major indices in terms of breadth.
Okay. All right. Well, of course, we'll be tracking this, folks, on a weekly basis with John and Mike and the team there at New Harbor. So we'll keep you abreast of, how their opinion may change based upon how the data changes on the ground. John, if we can, since we were talking about commodities with Tavi, if we can just talk about gold and silver for a bit here. So, obviously, they got just clobbered, I mean, just historically clobbered on Friday. Um, Everybody went into the weekend in a huge panic hey, how much further might this have to fall? We've seen some stabilization, the day we're talking here, I think they were up. They're maybe back to flattish for the day. Um, Probably still too early to answer that question I asked Tavi, which is, hey, is this a repeat of 2011 and 1980, or is this going to have more resilience and you know do higher prices lie ahead here at some point? Um, I guess first and foremost, do you guys have how are you guys tracking this at New Harbor? And I am just curious, like, what counsel are you giving to your clientele that is invested in precious metals of the miners?
Yep. So we chatted. I was fortunate to join you after your interview with Michael Oliver last week,
Hmm.
and we talked. I shared a chart there that we were actually quite concerned about the near term in precious metals. I shared a couple of charts that showed that both gold and silver were well above, in the 99th percentile of their historical extremities, relative to extension above certain moving averages. Um, you know, we certainly we didn't necessarily believe, think there was going to be a 30% intraday drop in silver. I think the very next day after we chatted, might have been a day or two after that, but things were really super extended, almost in an unhealthy way. And frankly, our positions for in our core models for precious metals, we had hedged very robustly. So much so that, we missed out on some of that last gasp, rise in silver, for example. We had very deep in the money call options that, we basically were standing aside as silver went to the moon from, we got a very nice run there. Many of our clients were up double, triple in the holding there, but it got a little too far too soon. And, therefore the pullback that we saw on Friday, the 28%, I think it was at the end of the day, pullback, was a non-event for our clients in that particular holding. But we did use that pullback. And let me just share a chart of this is a chart of, well, it's GLD. Let me pull up SLV, which is widely followed silver ETF. Here's that drop. We had a massive, massive drop here on Friday, and it's been a bit volatile. We had a couple of up days here in the last few days. We're well off the highs of today, but I talked on that video we did last week, Adam, that even just pulling back to the 21-day moving average, which itself is a bit extended, uh, this line right here would have been a near 20% decline. And we ended up tagging the 50-day moving average here, this green line. That pullback. Remains to be seen. I would agree with Tavi that nobody knows the near term path of precious metals. Not us, not anybody. We do think that was a healthy pullback, and I would not be surprised to see more volatility. Um, but the big picture hasn't changed. If you think about, talking about silver, go back to 2011. A lot of people are wondering, I think naturally, was what we've just seen there the repeat of the 2011 kind of bubble, if you want to call it, in precious metals, where both silver and gold peaked and then sold off hard and then went nowhere for the rest of the decade. That was prior to much of the financial monetaryism and fiscal spending that we've seen. So I think it is different now. The fundamental backdrop is wildly different. QE3 hadn't been done yet. I think in 2011, silver, for example, saw a 10 to 15% drop early in 2011, and then followed by a 30% drop, which was then the shoe that led to further weakness. Uncannily, we saw about a 10 to 15% pullback in silver in October of last year. And then fast forward 3 months, just like in 2011, we just saw a 30% drop. So there is a rhyme there, but I think the backdrop is completely different right now in terms of, I agree with folks like Ray Dalio, who's talked about this is really a statement about it's not an investment per se. It's a hard currency. It's what the world's, gold, especially the world's central banks are consciously and actively diversifying away from such heavy reliance on dollar assets in their reserve policy. They're using and intend to use more and more gold. So I think the paradigm is shifted. So the bottom line is we don't think the bull market in precious metals is over. We think it'll likely be volatile here in the near term. So two pointed takeaways for that. Folks that are, even with the pullback, many folks are still what you might objectively considered over allocated to precious metals. Absolutely sell down some, take some chips off the table. You don't need 50, 60, 80% of your assets in precious metals. In fact, I would say it's imprudent to do so for most people. Our target allocation is 12.5% right now, 10% in gold miners, 2.5% in silver bullion. Um, you know, if you have a much higher allocation to that, ask yourself real hard questions. Is it appropriate? Not too late to take chips off the table. We're still up on the year, Matt, very, very nicely on just on the year. We're not even, a little over a month in. So don't feel like you have to wait for the top to be reached again. It may very likely get there, but that's beside the point. Uh, get your position size down to a proper level. For those folks that don't have exposure, it's absolutely not too late to think about a thoughtful, stepwise way to get in there. 3, 5%, whatever to start. Dollar cost average in. Again, I'll just point to Ray Dalio again. I've mentioned him a couple times. He's been on the airwaves talking about for even most passive investors, 5 to 15% without even thinking about it is probably the right thing. I'm not here to give personalized financial advice. Certainly our team is available to do that. But that sounds about right. And again, if you don't have it, not too late to start toe dipping in and think about dollar cost averaging in a very thoughtful way, especially if there are weekdays that you can buy at a lower price.
Okay. Thank you for that, John. And again, you and I were having discussions just a week ago, before the huge drop in the precious metals about the prudence of hedging. And of course, many different ways to hedge. Some could have just been as simple as selling, some of your exposure. But I was talking about my personal strategy of hedging. You just showed us how you guys hedged at New Harbor and basically made that drop essentially, as you said, I think sort of a non-event for your clients there. And I'm sure there are a lot of people who are, looking at some of their losses since Friday and saying, "Man, I wish it had been a non-event for me." And now again, you gave up some of the upside there because you stood a step aside as the party really got wild. But again, as we've talked many times, the in many ways the secret to success of wealth building over time is more defense than offense. I mean, yeah, you've got to be putting your capital in, but you got to make sure that you're not putting it at risk of really losing it and setting yourself back years or more. So anyways, glad to see that you guys did that for your clients there. And it's just a good, like I said, validation of what we've been talking about here. One point on gold real quick, which this is a deeper discussion for a different day. But a lot of, part of the pushback that people have on gold is that, well, it doesn't do anything. Right? It doesn't serve any purpose, right? It just sits there and gathers dust, right? Sure, there are some commercial uses for it, but literally, or for the most part, it just sits there as an inert object that doesn't generate any income, right? It's not, literally, it's just a dust collector. And I think the thing that is often overlooked with that point of view is, no, it serves a role, money. And when it really comes down to it, what serves as money in the world? And I think what we're finding out in kind of real time here, which folks like you and I have probably thought this way for a good long time, John, but is that we have a bunch of fiat solutions out there, but those really are currency. They're not stores of value, which is a key component to what money is. And there have been, some potential competitors in the money space of late, Bitcoin, whatever. I think the jury is still kind of out on that. But when you really think about it, there really aren't that many, solutions out there that truly perform the role of money. And the central banks have certainly been sending a signal over the past few years that, yeah, we used to call this thing a barbarous relic, 10 years ago or so. We used to be super dependent on it. We kind of felt like we had broken the chains. We all got off the gold standard. But now they're realizing, what? There just really aren't many or any superior options out there besides gold as money. And you can't run a global economy and financial system without money underlying it. So I think that's the big thing to make sure you don't overlook when you just say, hey, that lump of metal just sits there.
Yeah, Adam, I'm glad you raised that because I think people really should think about precious metals, especially bullion, differently than they think about investments. It's not just a thing, investments are, hey, I'm going to buy something and the price is going to go higher. I think precious metals, gold especially, has a much more important role than that. Yeah, hopefully the price goes higher, but it's an insurance policy on a whole bunch of other things. And it should say everything to your viewers that the policy boards who literally control the printing presses, the central banks, they literally control the printing presses of fiat currency, are themselves not only large holders, but intend to be larger holders of
Right.
gold, not
They're
less.
they're currently aggressive accumulators of
They
gold.
have been for the last several years, and if you look at the World Gold Council's annual survey of the world central banks, over 70% in the last survey, over 70% of the world's central banks anticipated increasing their gold holdings over the next 5 years, and over 70% of those same central banks also indicated that they would be decreasing U.S. dollar parts of their reserve. So it should say everything. Forget the headlines. Forget it should say everything that the keepers of the printing presses are themselves choosing to allocate to precious metals. I want to share a couple of quick charts, Adam, just to hopefully not beat this to death. But here's a chart that compares since basically the bottom of the tech bubble in October of 22, the S&P 500 versus gold. Now I'm going to point out that gold over this period of time, this is as of the end of 2025, outperformed the S&P over that period of time. I intentionally chose the bottom of the tech bubble because there are other charts here that are cherry picked maybe to start at the peak of the tech bubble in 2000. And you'll hear people say, well, geez, if you couldn't have picked the worst time to compare yourself to the S&P. Well, I purposely chose the bottom of the tech bubble, which was a great time to start buying stocks. But I also want to caution folks, this I think improperly frames gold in the same way I caution folks not to. Don't think about it like an investment. Think about it as a hard currency. And when you do that, you can see if we take that same S&P chart and recast it in terms of gold prices, not US dollars, the S&P has actually lost money. So think about gold and precious metals as a base unit of currency, hard currency, not an investment unto itself. And you know what? If precious metals don't do well, it means a lot of other things didn't go wrong that we should be concerned about. But and that's why the real takeaway here is not necessarily whether you should or you shouldn't. I think that you should, but it's equally as much to say you shouldn't have too much because there are some scenarios where that insurance isn't needed as profoundly as some people, even we, might think it's needed. And great, just like house insurance, just like
Right.
health insurance, you hope you don't need that insurance. A good thing when you wasted some money on insurance.
Yeah. And on that too, like, I mean, as a betting man, I mean, I don't think we're going to have like, Lord of the Flies breakdown of the world financial system. But I think odds probably aren't bad that I'm going to be leaning on the insurance elements of gold at some point in my lifetime. But if I don't, the plan is pretty much to transfer those ounces to, my children, right? So to have it be an insurance policy that lives beyond my life, right? So, unlike a life insurance policy that ends with me, this is one that actually can continue for generations.
Yep, absolutely. And until the world central banks stop printing, and still the governments across the world stop spending, beyond means, I think you're going to continue to see fiat currencies, not just the U.S. dollar, but fiat currencies across the world. And every country has the same problem. Europe's got the same problem, not a country, but a monetary union. China's got the same problem. Japan's got it's not a U.S. problem. It's a global problem. Too much printing, and if there's one thing that governments will never want to do, they don't want to default on too much debt. They're going to inflate it away. And that is reliably a paradigm where, fiat currencies lose their purchasing power. You look at a US dollar can only buy 7 cents worth of what a dollar could buy in the post right after World War II.
Yeah.
That is real. It's not imagined. It's real. And that's why things like precious metals not only have been important, but have become increasingly more desired in recent years, and we don't
Right.
think that's over.
And it buys what, 20% less or more less than it did just at the start of COVID. I mean,
Absolutely. Yep. Yep.
yeah. Okay. So John, thanks so much for this. You're, one of those, in my opinion, relatively rare financial advisors who understands the role that precious metals can play in a portfolio. And, looking at the universe of financial advisors out there, most not only talk critically of the precious metals, or they just don't even want to talk about it with their clientele. And in large part of it's because they really don't understand the macro scene the way that you and I look at it. But just more pragmatically, a lot of them don't want to talk about it with their customers because they don't earn money off of it, right? It's not something that they can charge fees on, and so they obviously try to steer people away from it. What I really value about you guys at New Harbor is not only do you get it and you really work to educate your clientele about why you choose to invest in part of your portfolio model portfolio in those assets, but along with things like encouraging people to pay down debt, excessive debt, it's sort of one of the things that you almost, kind of, I don't want to say necessarily require, but strongly advise clients as you onboard them to say, hey, before you give us your capital to manage the financial part of your portfolio, kind of give yourself the foundational stability that we think sets you up for success in the long run. So get rid of excess debt, buy some precious metals, et cetera. And that's, it's not going directly to your benefit to be making that recommendation. Now, I know you're going to benefit much more in the long run because you're building trust and you're creating a more financially sustainable client there. But like I said, a lot of firms don't do that.
Yeah, they don't, Adam, and I can't say I don't understand that. I don't understand it because it's actually one of the most fulfilling parts of our job to counsel our clients to do important things with their money, other than to have us manage it. For example, and precious metals and other, paying down debt and stuff like that. Those are no-brainers. But encouraging them to go on trips. One of the most fulfilling things we can do is when we can, through objectivity and counsel, relieve some stress for our clients. And oftentimes, our clients have sacrificed, they've saved, and they're fearful about running out of money, or they're fearful about a major reset or whatever. And it's one of the funnest things of our job where we can encourage them that no, you're going to be okay. You've done the right things. We've positioned your assets properly so that if all your worst fears come to fruition, you're hopefully still going to be okay. We think you're going to be okay, and go enjoy life. Go enjoy life. Don't obsess about your money and what it's doing every single day. So yeah, and we're not going to look at folks like they have a third head. Our clients are very rational, wise people. They come from all walks of life. They're not bunker mentalities. I think much of our industry, and we hear it from folks who come to us. They're like, yeah, I tried to talk to my advisor about having some gold and silver and whatnot, and they look like I had three heads, and they made me feel stupid and foolish. Like they joked, "What are you going to do? Buy some ammunition and guns now too?" And just it's a great, I think, insulting part of the mainstream financial industry that they don't even acknowledge the credibility of the question. Never mind the advice that comes from it.
Yeah, I hear that all the time as well. Anyways, big thank you to that. So, folks, as we wrap up here, first off, if you want to take advantage of some of these trends in the commodities space that Tavi put on our radar, or you'd like to get some, just practical help from a good financial advisory firm of the type that John just mentioned, I highly recommend you go find that guidance from a good professional financial advisor, one who takes into account the issues that Tavi and John and I have talked about in this conversation. If you've got a good one who's advising you on that, great. Don't change a successful formula. But if you don't have one, you'd like a second opinion from one who does meet that criteria, maybe even John and the team there at New Harbor themselves, then consider scheduling a free consultation with one of the financial advisory firms that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to help as many people as they can. If you'd like to see Tavi come back on this channel, again, in the relatively near future, please let him know that by hitting the like button and then clicking on the subscribe button below if you haven't already, as well as that little bell icon right next to it. If you'd like to see Tavi do a deep dive in a particular sector of the commodity landscape, let me know in the comment section below, and whichever sector gets the most votes, I'll ask Tavi if he'll come on and talk about that soon. Then last, I just want to remind everybody that the Thoughtful Money Fall Online Conference is now available to buy tickets for. Again, that's going to be Saturday, March 21st. Don't worry if you can't watch live on that actual Saturday, because everybody who buys a ticket will get sent the replay videos of the entire event, all the presentations, all the live Q&A. Folks, there's going to be over 10 hours worth of content. It's just a completely insight-packed day. As I've been mentioning, our best lineup ever of speakers. I've got to print it out so I have it in front of me the next time I do this because I'm always doing it from memory now on these shows. But it's Lacey Hunt doing his regular, fantastic chart-packed keynotes. He'll be kicking the day off. I think we've got Luke Roman, Ed Dowd will be joining for the first time. We'll have Michael Howell, we'll have Darius Dale. We're going to have Matt Taibbi joining for the first time. We'll have Judy Shelton, Daniel DiMartino Booth, Grant Williams, Stephanie Pomboy, Rick Rule, Melody Wright, Andy Scheckman, Brent Johnson. There's a few more I'm forgetting, but as you can tell, folks, this is just a murderer's row of some of today's best thinkers. And given where this year looks like it's headed, which very much might look and feel quite different than the past three, which gave us, relatively easy ride, 20+% gains in the markets. This really could not be more timely. So if you want to go buy your ticket, go to thoughtfulmoney.com/conference. And anybody who buys now will get the lowest early bird ticket price. I want as many people to get that lowest price as possible. And if you, above and beyond that, subscribe to the Thoughtful Money Substack, I've sent you a discount code. You can use that code to get an additional $50 off of that lowest early bird price. All right, John, thanks so much for hanging with me for yet another week. Great job again today. Really look forward to seeing you again next week and making sense of whatever happens between now and then for our viewers.
Always a pleasure, Adam. Thanks so much, and we'll see you soon.
All right, and everybody else, thanks so much for watching.